Hello and welcome to the Weekly Forex Outlook at xm.com. Next week, traders will be watching to see if the US dollar will continue to gain amid still sticky consumer prices. In addition, we'll get the employment report and GDP data out of the UK, as well as jobs data out of Australia. Aussie traders will also keep their eyes on China's data, as the Chinese economy may have shown progress in October. I'm Maria Pachordiz, and joining me is senior market analyst Harlambos Pissouros. So Harlambos, let's begin in the US, where last week the Fed decided to cut interest rates by 25 basis points, and Powell delivered a hawkish message regarding a December cut. The US government is still shut down. What will this mean for the upcoming CPI data and the dollar?
Hello, Maria. Yes, indeed, the government remains in shutdown, breaking the prior record of 35 days. Still, this has not had a major impact on the markets, but it delayed the release of major economic data like the non-farm payrolls and most probably the CPI report that seems to have been scheduled for next Thursday. Now, even if the government reopens beforehand, the Bureau of Labor Statistics may not have data to work with like it did with the September report, so it is extremely unlikely that we will get the report. As for the US dollar, the fact that Powell pushed back against a December rate cut, combined with the slightly better than expected ADP report and the improvement in the ISM non-manufacturing PMI this week, allowed traders to scale back their rate cut bets. They are now assigning a 65% chance of a December rate cut, and they are penciling in only 60 basis points worth of reductions for next year. Now, ahead of the decision, a December cut was fully priced in, while 3 additional reductions were expected for 2026. Now, as for inflation, even though we are not getting, most probably we are not getting the CPI, we can have an idea of how inflation may have fared during the month of October. Although the ISM manufacturing prices sub-index slid, the corresponding non-manufacturing sub-index rose somewhat. So given that the non-manufacturing activity accounts for around 90% of US GDP, I think that the risks to the CPI numbers, whenever they are released, may be tilted to the upside. That said, the Cleveland Fed inflation nowcast suggests that both the headline and core CPI rates held steady at 3% in October. Still, that's well above the Fed's objective of 2%, and in my opinion, it corroborates the view that the Fed does not need to rush into further lowering borrowing costs. So, even if the shutdown continues and the Bureau of Labor Statistics does not release the CPI report, I believe that the US dollar may continue to gain as other private and Fed compiled data point to still sticky consumer prices.
Moving to the UK now, we'll get the employment report for September on Tuesday and the preliminary GDP data for the third quarter on Thursday. What should pound traders look out for?
The disappointing jobs data for August was one of the variables that led investors to adopt a more dovish view on the Bank of England's future course of action. And indeed, this week, on Thursday, British policymakers decided to hold interest rates unchanged, but that was via 5-4 vote, with the 4 dissenters favoring a 25 basis points reduction. The minutes also revealed that Governor Bailey judged that the overall risks to medium-term inflation had moved down, which raised speculation that he may join the rate cut camp at the upcoming decision. Now, according to the UK overnight index swaps market, a 25 basis points rate cut by February is more than fully priced in, with December receiving a 55% chance. Therefore, having all that in mind, another weak jobs report and signs of subdued economic activity could intensify speculation that the Bank of England could indeed cut interest rates in December, which could push the British pound even lower.
Turning to Australia now, the RBA kept rates steady on Tuesday. How is the Australian economy doing at the moment, and how might the upcoming jobs data impact the RBA's next moves and the Aussie?
At this week's meeting, the RBA kept interest rates steady and noted that inflation has picked up, moving materially higher than expected in the August quarterly statement of monetary policy. The November projections were based on the assumption of one more rate cut, and they revealed that inflation, as measured by the trimmed mean CPI, could rise above 3% in coming quarters before settling at 2.6% in 2027. Now, with the monthly headline year-on-year CPI rate rising to 3.5% in September, and the 12-month inflation expectations rate of the Melbourne Institute inching up to 4.8%, which is well above the upper bound of the RBA's 2 to 3% target range, investors are not fully penciling in another rate cut by this central bank, by the RBA. They see, though, a decent 85% probability of a final 25 basis points reduction in August 2026. Now, given the RBA's dual mandate of price stability and full employment, improving labor market conditions during the month of October could prompt investors to further scale back their rate cut bets, and this could thereby add fuel to the Aussie's engines.
And finally, is there any other data coming out next week that traders should keep their eyes on?
Yes. Aussie traders may also pay attention to China's data due out on Friday. China will release retail sales, industrial production, fixed asset investment, and its unemployment rate, all for the month of October. Now, from the Eurozone, we get Germany's ZEW survey on Monday, and on Friday, the second estimate of GDP will be released. The EU Commission will also publish the autumn economic forecasts at the same day. I think they are released on Friday, and it remains to be seen whether the European Union is expected to continue to perform well, even with the European Central Bank not signaling additional rate cuts for now.
Harlumbus, thanks so much. This was the Weekly Forex Outlook here at XM.com.